Fixed versus variable, it's always topical. It's always a good debate, especially between mortgage and real estate professionals and even, end users. And we thought we'd bring some context into does it make sense in this year. So just as like a quick refresher in terms of what a variable rate is in comparison to a fixed, very simply, the conversation I always have, a fixed, it's set it and forget it. You know what you're getting, you know what your interest rate is, you know what your payments are going to be for the full term that you sign up for. A variable rate, of course, is a floating rate. It's going to move up and down, and your interest costs are going to change every time your interest rate moves up or down. Probably the biggest difference between the two, other than the fact your rate and payment can change, and something that we all hammer home with all our clients taking variable rates, is penalty differences, right? Especially if we're talking about a major bank, especially if we're talking about a longer term fixed, i.e. 5 years, which is the most popular mortgage taken in Canada. Fixed rate penalties can be substantial. The example I always use, you're going to pay upwards of 4 to 5% on the high end of your mortgage balance if you break a fixed rate in the middle of your term. So what does that look like? You owe $500,000 on your mortgage. You want to sell and break your mortgage middle term. That penalty could be $20,000 to $25,000. If you're variable, the penalty you're always going to pay from day one till 2-3 months from completion or maturity. If you pay that mortgage out, you're looking at a 3-month interest penalty. If we compare it to that same $500K example, depending on where rates are, your penalty could be anywhere from $2,500 to $5,000, maybe a touch higher, just in comparison to fixed. So those are sort of the two main differences. Of course, with a variable rate, conversation we always have is, you're floating, but you do have the option to sort of lock in, right? And the important distinction there is you're not locking in, you're not freezing the rate that you have. You can convert that variable rate into whatever fixed rate offering the bank has at that time. So, a lot of us are sitting in variable rates right now with maybe a plan to let fixed rates slide back down and then convert your variable rate into a fixed rate. So that's features only a variable or available to a variable. Obviously, with a fixed, you're stuck with what you're paying for the full term. Obviously, the questions we get: how and why does your rate change? They're always going to change by decisions by the Bank of Canada, whether or not they're going to raise or lower rates. But there's two different variable products. Really jumping in the weeds a little bit. I don't know if anybody wants to take that on, kind of talking between a fixed payment or static and an adjustable.
The variable piece. So there's an ARM, we call it an ARM in the finance world. It's an adjustable rate variable mortgage. And then there's a true variable. The adjustable rate is just how it sounds. So if the Bank of Canada raises interest rates by 0.25%, your rate raises by 0.25%, and your payment is also a forced increase.
Fixed versus variable, it's always topical. It's always a good debate, especially between mortgage and real estate professionals and even, end users. And we thought we'd bring some context into does it make sense in this year. So just as like a quick refresher in terms of what a variable rate is in comparison to a fixed, very simply, the conversation I always have, a fixed, it's set it and forget it. You know what you're getting, you know what your interest rate is, you know what your payments are going to be for the full term that you sign up for. A variable rate, of course, is a floating rate. It's going to move up and down, and your interest costs are going to change every time your interest rate moves up or down. Probably the biggest difference between the two, other than the fact your rate and payment can change, and something that we all hammer home with all our clients taking variable rates, is penalty differences, right? Especially if we're talking about a major bank, especially if we're talking about a longer term fixed, i.e. 5 years, which is the most popular mortgage taken in Canada. Fixed rate penalties can be substantial. The example I always use, you're going to pay upwards of 4 to 5% on the high end of your mortgage balance if you break a fixed rate in the middle of your term. So what does that look like? You owe $500,000 on your mortgage. You want to sell and break your mortgage middle term. That penalty could be $20,000 to $25,000. If you're variable, the penalty you're always going to pay from day one till 2-3 months from completion or maturity. If you pay that mortgage out, you're looking at a 3-month interest penalty. If we compare it to that same $500K example, depending on where rates are, your penalty could be anywhere from $2,500 to $5,000, maybe a touch higher, just in comparison to fixed. So those are sort of the two main differences. Of course, with a variable rate, conversation we always have is, you're floating, but you do have the option to sort of lock in, right? And the important distinction there is you're not locking in, you're not freezing the rate that you have. You can convert that variable rate into whatever fixed rate offering the bank has at that time. So, a lot of us are sitting in variable rates right now with maybe a plan to let fixed rates slide back down and then convert your variable rate into a fixed rate. So That's features only a variable or available to a variable. Obviously, with a fixed, you're stuck with what you're paying for the full term. Obviously, the questions we get: how and why does your rate change? They're always going to change by decisions by the Bank of Canada, whether or not they're going to raise or lower rates. But there's two different products, two different variable products to really jumping in the weeds a little bit. I don't know if anybody wants to take that on, kind of talking between a fixed payment or static and an adjustable.
The variable piece. So there's an ARM, we call it an ARM in the finance world. It's an adjustable rate variable mortgage. And then there's a true variable. The adjustable rate is just how it sounds. So if the Bank of Canada raises interest rates by 0.25%, your rate raises by 0.25%, and your payment is also a forced increase. There's nothing you can do to stop that. So the downside to this product is if affordability is a concern and you're in a variable and rates continue to rise like we just saw over the last 12 to 14 months, your payment is going up and there's nothing you can do to stop it outside of potentially maybe converting or refinancing into a fixed or what have you. But that's an adjustable rate. So there's pros and cons. If you can afford it, your payment increasing along with interest rates allows you to maintain your principal pay down and your original amortization, right? Now, moving into the actual variable with a fixed payment, essentially how that works is at time of funding your mortgage, if your payment's $2,000 and your rate is 2%, as rates rise, your payment actually doesn't rise. What's going to happen is you're going to start paying less of your principal and more interest to the bank. So what we've seen very commonly over the last 12 to 14 months, because of the dramatic rate increases that we've seen, it's actually gotten to a point where a lot of people are not even covering any principal on their mortgage and their payment has stayed the same. So on a high level, like pros and cons, if affordability is a major concern, maybe you've lost your job or what have you, having that fixed payment variable is phenomenal because it's not going to impact your pocketbook, but your amortization on your mortgage and just the structure of your property and your financing is going to look a lot worse long term. Another thing, a lot of people that take on variables on rental properties, they like to have the fixed payment variable, again, for cash flow purposes, right? Maybe you're cash flowing $150 on that property. And if it was an adjustable rate mortgage and your payments go up by $500, now you're actually out of pocket and that might not be affordable or just, attainable. Now, again, so the amortization piece is huge. Understanding that product before you go into it, I think, is massive. And this is where you have to have detailed discussions with your broker, right? Like people just talk about variable as a blanket product. Maybe you're going to one institution because you qualify there and it's a variable, but really understanding what the worst case scenario could be. And this is like every time we talk about rates, my mind goes to, like, you need to understand your worst case scenario, whether it's a fixed or if it's a variable. Like if you're in a fixed, just like Tyler mentioned, are you aware that you could run into like a $30,000-$40,000 penalty as a worst case scenario if you have to break that mortgage early and you can't port it or whatever for whatever reason? Like, are you okay with that, right? And are you okay being in that rate and that payment for a set period of time? And if you are okay with that, you're probably good to go, right? And if you're in a variable, like an adjustable rate variable, and you're of the understanding that if rates went up by 2% and your payment's going to go up by $2,000, can you afford it? And if you say yes, again, you're probably good to go, right? Like you need to think about these dramatic situations because, I've been doing this for a little over 10 years and like rates have been relatively low the whole time. And we've seen a massive uptick. And a lot of people that are in variable products have realized that that's probably not the product for them now that we've been through a situation like that.
You hear in the media that rates are going on the move and everyone just assumes that fixed rates are moving too. So fixed rates are deemed by the bond market and variable is done by the Bank of Canada, like Tyler alluded to. So a lot of times you're going to, we have an announcement coming up next week or 2 weeks from now. And people are assuming that rates are going up again because of the way inflation's been the last little bit here and what the Bank of Canada has come out with. So I know my talk with clients have been very, maybe we need to wait a little bit. Maybe we need to put things on hold because they don't fully understand the whole concept and what different products are out there.
Just looking at an adjustable rate mortgage, when is the right time to take it? We may be getting to a time where that does make sense because we, in the next 12 to 24 months, most experts, chief economists at the big banks do expect rates to come down. Like they are pricing in a rate cut from the federal government. And that would be a good time to ride an adjustable rate mortgage because your payments are ultimately going to be forced downward. So in Derek's example, he was discussing the Bank of Canada raising rates by 0.25%, where in this scenario, the Bank of Canada could be dropping 0.25, 0.5%. We've seen significant deep cuts in the past, like the pandemic is a great example in in early 2020 where, 3 emergency rate cuts back to back, 0.5%. Before you know it, within a 30-day period of time, your interest rate dropped by 1.5%. These are very realistic measures that could come back. Yes, we're dealing with sticky inflation, but as soon as that turns, it can be a quick turn, and we could really see the economy go in a very different direction, and the Bank of Canada have to make some serious decisions and cut rates. So, is that coming anytime soon? No, probably not. But in the next 12 to 24 months, experts are pricing in a rate cut. So that's where I would look to really, weaponize, I guess, the adjustable rate mortgage to your benefit. So, just looking at that, like it's a good segue into like, when does this make sense to go variable or adjustable rate mortgage? I mean, if we're really trying to pinpoint that, maybe early next year, if your mortgage is coming up for renewal in the next, say, 12 to 24 months, like, obviously evaluating the market, looking at that timeline, that could be the time to start to target that for an adjustable rate mortgage. But, looking at it as of right now today, these rates are on average 1% higher than the best 3-year fixed or 2-year fixed. So a lot of clients today are going with a 2-year or 3-year fixed, and looking at their opportunity to renegotiate their term in that 2-year or 3-year timeline, because that could put them in the perfect wheelhouse to be looking at an adjustable rate mortgage at that point in time.
Does it make sense to go variable in 2023, even weighing both different types of products? In my mind, like there probably are a few instances where it does make sense, but I had someone explain to me when I got into the mortgage business about 12 years ago, whenever you see a variable rate that is 0.75% or 0.75% cheaper than any of its fixed rate counterparts, that's probably a good time to grab it, right? Because typically, at least in the context of the last 10 or 15 years, we're only seeing rate moves by maybe 0.75% to 1.5% in any rate hike cycle. Obviously, this last 18 months has been, substantially more than that. And the reason why, if you saw that discount from fixed to the variable option of 0.75%, is because you're taking on that quote unquote riskier product in terms of where your interest costs could go. And right now, you're actually needing to pay a significant premium, i.e. a higher cost mortgage, to get that quote unquote riskier product, like Dean mentioned. We're seeing differences of upwards of a full percent based on different term comparables going variable versus fixed. So what that means is, for you to take a variable today, you were signing up for a substantially, in some cases, more expensive mortgage product with the plan, the hope that rates drop sometime in the near future. And as Dean mentioned before, like, inflation's been a little bit sticky. The volatility in the bond market this year is something we've probably never really seen. Does it make sense to go variable in 2023? There's probably a few instances. I don't know, Derek, if you want to touch on maybe where it does make sense. But for my money, for the average consumer, it probably doesn't. Maybe go shorter term in your fixed, but I'll let Derek touch on that as well.
Yeah, I mean, I'll just speak from personal experience, and I guess what our office is seeing, like when I look at reports of what direction clients are going and what they're choosing. And I can say this pretty bluntly, like I'd say 80% of the clients that Thrive is working with, they're going into a short-term fixed. Most commonly 3-year, a little bit of 2-year. The 2-year rate's a little bit more expensive, but I was looking at some of the variable mortgages that we've funded, and a lot of the situations, it's like someone that knows that they're going to be changing something in the next 6 to 12 months, right? Like someone that is actually planning on selling their property in 6 months. They're not quite there, so an open doesn't make sense because the rate's going to be a lot higher. So locking into like a 1-year fix or 2-year fix at inflated rates, knowing that there might be something better available at the time and a port won't make sense, that's where a variable could really actually capture some value and hopefully become cost effective for you, right? Outside of that, like the biggest argument that I've seen is you compare a 1-year fixed to a variable, and 1-year fixed for owner occupied, you're sitting around like the 5.6 to 5.8% range, depending on the lender. And if you look at the cheapest variable for the same type of property, owner occupied, what have you, it's like 5.9 to 6%. So as much it is more expensive, it's a relatively minimal gap in rate. So I would say the person that's going to choose the variable over the 1-year fixed is someone that is just good with the risk, right? And like they're hoping for that reward, and for whatever reason, wherever they're getting their information, they're thinking that rates actually might come down sooner than expected, right? But I would say, like, if I had to make that choice, I would probably be taking a 1 year fix, because it doesn't seem like we're going to see any dramatic changes in the near future. And I think a 1 year just kind of buys you some time through all the volatility that we're dealing with.
Yeah, when it doesn't really make sense to go a variable rate right now is your budget's tight. If you're on a fixed income salary, or just you only have a certain amount coming in, maybe if your life income is about to change, your significant other is going to go on mat leave, something like that. Or if your income maybe fluctuates because you're a seasonal worker, we're generally seeing those type of clients not take a variable rate. Or at just the end of the day, if your budget is tight, if you're looking to qualify for a little bit more money because of that, the higher rate premium going into the riskier product, you're qualifying for a little bit less. So if you're, that first time buyer, your down payment's very limited. Generally speaking, we are looking at like that 3 year, because it is a significant discount from where the variable rate is, which is going to allow you to qualify for a little bit more money.
Looking at rate cuts, they usually come in a much smaller margin and slower fashion than when the rate goes up. So, just to put that in real simple context, like rates go up quicker than they go down. It's always that way. Again, going back to the pandemic, early 2020, that was a real rare situation where the Bank of Canada just did, 3 significant emergency rate cuts. It was unprecedented at that time, and we shouldn't expect that type of a situation to come again. We really shouldn't expect that. So we should expect slow decreases. So what I mean by that is, like, when they eventually do come, if the experts are right, and we're looking at first quarter of next year, we see our first rate cut, it will probably be 0.25%. So if on average you're sitting at 1% higher on the variable rate today, so like let's say we're looking at a new mortgage today and we're choosing between a 5-year variable and a 3-year fixed, we're probably 1% easily higher on the variable today than the 3-year fixed. And for that rate to from the variable rate to drop to even the same point that you're currently at on 3-year fix, it's probably going to take a year, maybe more, to even get there. So I definitely agree with Derek and the rest of the team here. I would be looking at probably a 1 year. I'd probably go with a 2-year fix, to be honest, just to kind of have the peace of mind and not have to like relook at this in 1 year. 1 year goes quick, 2 years goes quick, and ultimately 2 years of just peace of mind, knowing my rate, my payment are going to stay the same. That's probably what I'd be targeting currently. And just one instance where it definitely makes sense to go variable in all other situations would be if you're planning to sell. Like, we've had a lot of people like targeting a potential sale date of any time in the next 12 to 36 months. If that's your situation, I would definitely be considering a variable because of the penalty structure that Tyler mentioned earlier. Yes, people think they can port and just move their mortgage to the next property, but a lot of times people are increasing the debt that they need to buy the next property, or potentially they're significantly decreasing and they don't even need a mortgage. Like, penalties should be factored into your decision, and that is where I would definitely be looking to take a variable. Just kind of moving forward, it's like what the topic that I'd like to kind of round out this discussion would just be around what should you do if you're currently in a variable, and I'll open up there. I've been talking to lots of clients that have maybe 1 or 2 years left in their variable rate mortgage, and a benefit of almost every variable rate and adjustable rate mortgage is you can lock in to the best current fixed rate at any point in time with your current lender, depending on which lender you're with. If you consider you have 2 years left, and let's say you're averaging about 6.1% in your interest rate currently today, and you're looking at the best comparable 2-year fix at say 4.99 to 5.19, I would certainly consider locking in. I would seriously consider locking in that variable, and that it's just back to the same reasons I just mentioned of why I would consider taking a variable versus like a fixed rate product. If you're looking at a new mortgage, the same reasons apply, and I would seriously be considering that.
I had this literal conversation yesterday with a client of mine who's sitting in a variable rate and called me and asked, what should they do? In their situation, they're in a fixed payment, right? So the true variable rate, which basically all of our major bank partners and credit unions have. And the conversation went like this, like her rate at the time was basically 5.9%. She could lock in today at a rate that's easily a full percent cheaper, depending on what term she wants. But because of that fixed payment structure, they hadn't increased their payments with each and every consecutive rate hike. So Sure, we could get the interest cost down for them because we're going to lock into a cheaper rate. However, because their fixed payment mortgage is now almost entirely interest, their monthly payment actually jumped by like $700-800 a month. So we had that conversation with them, or with her, and they thought, that was a little bit more of a pain point for them, actually spending that extra money. And they have some bonuses that are coming in towards the end of the year. So they took the strategy, once we get our bonuses, we'll just hammer down the principal that way because we're comfortable with the cash flow that we have now. And they're a younger couple. The plan is to sell the next year or two and then move on, right? If I'm sitting in an adjustable rate where we know the rate and payment all change with decisions by the Bank of Canada, and your paying levels say a 8, 9, or 10 with your payment, you can absolutely call your bank today. You can lock that mortgage into a cheaper rate. You're very likely going to see your payment get reduced too, so it's going to offer you some forgiveness up front. My conversation when everybody's asking me about what should they do with their variable rate is, or even if they should take one, is like, what's your risk tolerance level, right? Are you comfortable with absorbing a bit of risk? Do you have cash reserves, cash savings? If the answer is no, then this is probably not the product for you, and maybe locking in makes sense for you at this time.
Just because everyone's situation is different, right? And you have to look, like, maybe someone got into that variable and when it was a really, really deep discount, and like you're sitting at like a 5.6 or what have you, and converting is only going to get you to 5.3. Like those situations, you have to kind of teeter on it. Obviously, there's risk in staying variable if Bank of Canada was to continue to increase, which is just completely an unknown, right? It doesn't seem like they will, but we really don't know. But if you're not going to see that much of a discount to go into a fixed, you also have to consider, like with certain institutions, if you're only 6 or 12 months into a 5-year variable, they're probably only going to offer you a 4 or 5-year fixed, which means you're now going to be locking in for a very long period of time at a very inflated interest rate. And if rates do come down in the next 6, 12, 18 months, we're probably kicking ourselves, right? Whereas there's other situations that I ran into where people have 2 years left on their mortgage and they're locking in at something a little bit cheaper and it's only for 2 years and it gets them through all the craziness. Like that's not a bad option, right? So you do have to consider the length of term that you're converting into. And like some institutions will convert you, even if you're 1 day into a 5-year variable, they'll give you an option for a 3-year, which I actually really like. Like that's done really well for a lot of people, but there's a lot of institutions that don't offer that. So I guess those are just the two things you have to look at before you sign to convert. Like how much are you actually saving? What is your risk tolerance? Like Tyler mentioned, like, do you have, like, what if rates do go up by another 0.5%? Can you handle it? Right. My mindset, like I have a variable mortgage and kind of feel like I'm pretty close to the end of a war in a sense, right? Like you've been through the battle, like we've seen the worst of it, hopefully. And if that is the case, like I feel like because we've fought through that, like I personally want to see the benefits when it comes back down. So, but again, everyone's situation is a little bit different, right? You gotta, if you're at, yeah, I won't reiterate that too much, but if you're in a position where you can't afford much more, then just making sure that you put yourself into a safe position and again, just understanding your worst case scenarios is important.
I have a handful of properties and I was able to convert a couple of them to the fixed. It saved me some money. And then the other ones were so new that it didn't make sense for me to lock in because I didn't want to lock into some sort of fixed rate for 4 years. Because for me, having a variable rate product is kind of like having an open HELOC. I can just restructure my mortgage, access equity as needed. But I'm a little bit more of a riskier borrower, I guess. So as to Tyler's point, it makes sense for me to keep those. And like Derek just said, I do think we're at the end of the war as well. So I'm hoping to, reap the benefits of the rates coming down, hopefully in the next 18 months and, access equity again.
We don't like to make predictions when it comes to the Bank of Canada, but, maybe it's just worth kind of giving our peace of mind of where we see this going. Because I do agree. I think we're at the end of the cycle here. I don't expect to see further increases. I know we've had discussion in the market around the next meeting. So, we're going to timestamp this podcast. We do expect a Bank of Canada meeting in the next 2 weeks. It's scheduled. It's happening, and there has been a lot of activity around the fact that there could be a rate hike because inflation it went up slightly. So it went up 0.1% in the previous report, but a big portion of that inflation data is shelter costs. 28% of inflation was actually shelter costs. So in theory, a lot of the metrics that we measure for inflation are actually down. Shelter costs includes mortgage rates, and they're up significantly from year over year. And that's a metric that the government uses. That's a dial that the government uses up and down. So, a big portion, 28% of that inflation is shelter costs. And so, looking into that, even Tiff Macklem said it himself, like that it's the inflation going up isn't a huge concern from that last report. And I personally, because of hearing what's come out, looking at the data, I personally don't think we're going to see an increase in June, and that's just my prediction, given what we've heard in the marketplace. So looking at that, if you have anywhere from 3 or 4 years or more left in your variable, that's a reason for me to just certainly not lock in or make any changes, because we could potentially be benefiting from the downward trend. So I don't know if anyone else wants to chip in with some predictions. Again, it's not something we normally do, but I think it's been so top of mind lately, it's probably worth a quick piece on.
As far as predictions, I'm not sticking my neck anymore after the last 18 months.
Yeah,
It's
fair
been
enough.
a bit of a bloodbath. And for the record, I'm sitting in a variable rate mortgage with my personal family mortgage too. So I'm watching very closely. But I think we probably hit it all on the head, and good chat for sure.
This isn't necessarily a prediction, but like Tyler touched on this, right now fixed rates for the most part are lower than variable, which is rare, right? Like I think we've seen that maybe twice in 10 years. I would predict that like we will get back to that at some point, whether it's in 12 or 24 months. Like that will like variable should come down, and then like the bond market, if anyone follows bond yields, which is crazy, most people probably don't, but it's been very volatile, right? Like it's come down, it's kind of shooting back up, and that's a piece that I won't even touch on a prediction, but I do think we will land back at a normal rate environment where fixed rates are between 0.5% and 1% higher than variable.
I think just for my final parts here, there's lots of talk about us heading into a recession. So when the recession comes, they bring rates down historically to get us out of the recession. Generally, we're very conservative as Canadians. In 2008, we were the first country out of the recession. So variable all the way. And I think the most important part is like you marry the house and you date the rate. So like you always want to look to try and save money when that's available.
Yeah, great points. I think we'll end it there. If anyone has any questions about their own mortgage situation, especially somebody that's in a variable or considering a variable rate mortgage, again, this based on all these examples we talked about, the situation is going to be unique to you and your family. So certainly reach out. Happy to have an assessment and go through anything that might be top of mind for yourself in making that decision. So yeah, thank you for everyone that was listening. Again, if you have any feedback or any comments you want to share with us, please do. We take that seriously. And thank you for listening.